Thanks to everybody for joining in. I see there's a lot of people still coming into the room, but we'll get this going. I'm Kurt Brown. I am the Chief Investment Officer here at Town Square. I'm looking at these names as they blast through really fast. I know a lot of people that are coming into the call. It's good to see a lot of friends here and people joining from all over the country, and really appreciate you taking the time out of your schedules to do this. And hopefully everybody's got a good start to the new year. Everybody's staying safe. We know there's a lot of sickness out there and crazy things going on in people's lives. So hope you're good. I'm joined in the room today by Josh Flade, who's the Vice Chair of the Investment Committee here at Town Square, and Monica Saunier, who heads up fixed income and all credit and rate work here at the firm as well. So the three of us will take you through the next few minutes and hopefully touch on a few things that are helpful, give you some insights on kind of what's going on. It's really hard to get good financial journalism that helps you understand sort of pros and cons, good and bad, of what's going on out in both capital markets, in the economy in general, and things like that. And we're sort of in unprecedented times with regards to some of the things that we're seeing in the economy. And we're working out a new playbooks. And so hopefully here we can share some things that are valuable with you, and have a good time kind of going through some of these things. This will be recorded and then sent out for distribution in the next day or two with the slides. So for those of you that would like to have a copy of that, you'd like to send it to somebody else to listen to or whatever, feel free. We love to share the information and hope it finds value with people also in your life. So look for that and feel free to send it along. So let's go ahead and dive in and maybe start talking with some of the good stuff. I will say, for those of you that are regulars on our call every quarter, that we're probably feeling a little bit more cautious. So you'll probably hear us having a little bit more of a cautious tone than maybe we've had in some of the prior calls. And we'll kind of dive into some of the reasons why. There's some things we don't love that are going on out there, and there's always things not to like. But in terms of balance of risks, there's some very, very good things and some things that are alarming. It's a really interesting time. So let's maybe kind of go through some of the really positive things first that we're seeing. Most importantly, you can get a really good barometer of what's going on in the country by looking at a couple of key issues, earnings and employment and things like that will give you a real insight into the genuine health and get away from sort of the talking heads and the rhetoric. And you look at earnings here. I mean, this is earnings going back to the late 80s of the biggest companies, right? The S&P 500. And look at how much growth. This number, by the way, is in the bag pretty much. That's about to move from being an estimate to a final number. So you look at the growth we've seen in earnings in just the past couple of years. I mean, you're going from, let's say here in 16 and 17, and we've doubled earnings in just a few years. You think about that. These are the biggest 500 companies in the United States that have doubled earnings in 5 or 6 years. That is real, super mega healthy economic growth. In the past 2 years, this is sort of a 2-year snapshot. I like this one because it's pre-COVID. So it kind of moves the noise of COVID out. Where did we go in 24 months? And you can see what the gross domestic product here in the United States did. But look at earnings. I mean, just in 24 months, that's incredible. And even sales, right? Even just the 1-year number, okay? This jump of 1 year, S&P 500 sales, this is revenue, top line, up almost 13%. That's the third largest rating ever for a single year of S&P 500 top line growth. That is really, really hard to pull off. Now, remember, 1 year ago was not the bottom of COVID, right? We're moving up on 2 years of that, right? So the economy had sort of already recovered, and now this is just 2021. That is really super, super impressive. Profit margins. Okay, this is something we're talking a lot about. Everybody right now is concerned about inflation, whether it's the cost of goods or it's the cost of employees. And so you would expect that profits are eroding because things are getting more expensive. And it's barely a blip so far, right? In this last quarter here, we saw just a little tiny tick down in profit margins. But you see what this has done since the early 90s. This trend line has been incredibly persistent. And corporations continue to find a way to get more out of the resources they have, largely due to technology, right? Every industry that you can name. I saw a news story the other day about these John Deere tractors that are working in fields completely by themselves with no human assistance whatsoever. So pretty much any industry that you look at is gaining a lot of advantage from technology. Employment is just absolutely red hot. The labor market is arguably the most bizarre and unique labor market we've ever seen. We're going to talk about that more. Monica will talk about that a little bit, Josh as well. But you look at that unemployment number, and granted, there's some asterisks around this, right? And you'll read, well, a certain number of people have dropped out of the workforce, right? So maybe the participation rate is lower. But no matter how you slice it, you have a really, really strong labor market right now. Look at the number of job openings. So you just look, I mean, the jump from the bottom of COVID is just completely insane, right? You went from 4.5 million job openings to 11 million in 7 quarters. But this trend line since the bottom of the financial crisis has been pretty good. So you're looking at an economy that acts really, really well. We manage the assets of many, many business owners in the country, and almost without exception, they are complaining about the employment picture. They're trying to hire. It's hard to hire. You have to hire, you have to pay more to get people, et cetera, right? So almost no layoffs, right? We're at 20-year lows by far in terms of the number of layoffs. You just can't lay anybody off. And then quits, right? Always the sign of a healthy economy is when people feel emboldened to quit their job and go try to find a better job. Households look fantastic. This is unbelievable, right? So you look at this is pre-financial crisis, not the bottom of the financial crisis. So this is what, maybe 14 years here. Look, you're more than 2x the net worth of the average household in this country. It's a massive, massive move. Believe it or not, debt has gone down. Nominal debt has gone down, and then the debt service has gone down. So you look, going into the financial crisis, people were spending 13% of their disposable income on debt payments, right? Look where it's at now. It's a massive reduction and multi-decade lows of what the average household is spending to service their debt. Now, hopefully most of this debt is fixed, right? Because the debt here that's floating, if interest rates go back up, this picture could change fairly quickly. But at the moment, households are really, really in unbelievable condition and not really trying to borrow money. Most of you join our quarterly calls. We're not going to talk about it again today. We talk about it so regularly, but there just really is not an appetite at the household level to take out a lot of debt, even with interest rates where they are. There is still just a lot of cash. There's no way around it. Here's sort of a year-end snapshot of 2021, right? So you can see that, it's sort of broken down by income group, but there is a lot of money sitting out here, and especially in, the top 10% wealthiest in this country are just stockpiling cash. Here's sort of another way to look at it over here on the right. This is cumulative excess savings. So we started, if you mark this pre-COVID, look at just the extra amount of money in saving accounts since COVID started. This is the extra. Consumers were already holding a lot of cash. Now there's almost $2.5 trillion in more cash that's sitting there. So that's one of the reasons the economy is acting so well, is there's this massive liquid tailwind to everything out there. Cash is everywhere. Now, what we have seen normalize, we talked about this a lot through COVID, is we've seen the normalization of the savings rate. So now people bringing home their paychecks are not jamming as much as they were. So there's a lot of cash out there, but in recent months now, there's not the same kind of fear that we saw before. People are normalizing their spending again, not quite so scared about the ramifications of COVID. We've shown this chart once before. This goes back to the early 70s. The orange line is the amount of deposits at all of our commercial banks in this country, right? Deposits continue to skyrocket, but loans are not keeping up. And all the way until the financial crisis, this was a one-to-one relationship. If a bank took $1 in, they wanted to lend that dollar out, and they got themselves in trouble because they lent to people that they shouldn't have been lending to. Well, that's changed. And so banks are sitting on too much money. So this is kind of a wonky, funny chart over here on the right for those of you that are interested in this kind of thing. But what all the chart on the right is showing is on a nightly basis, how much money are the banks trying to give back to the Federal Reserve for a tiny, tiny amount of interest. It can be like 0.05% per year of interest. The banks will try to give it to them at the tune of 1.6 trillion for a night, right? That it will show you how much cash banks are holding on to that they don't know what to do with. Okay, that's incredibly healthy for an economy to have that kind of backstop, that kind of liquidity in it. And it's one of the reasons, again, that the economy is acting so well. We'll just say this about housing, that it's probably going to cool here. We're not looking for a correction in housing, but it's almost for sure going to begin to consolidate. And we are definitively not in the camp that housing is about to go through some kind of bubble explosion and we're about to go through some sort of version of '08 again. You look at the number of weeks that a house sits on the market, at the end of 2020 or by late summer 2021, it's ridiculous. Like houses are on the market for a week, right? But if you look under the hood, and we've talked about this in the past for a couple of quarters, almost all of the mortgages that are being issued by banks that are really the highest credit quality, right? So the people buying real estate are either buying it with cash, or if they are using mortgages, they're in that highest credit group. So you're still not seeing any movement in that subprime element of the market. And then we've also kind of showed this in the past. You kind of look at how much the value of equity, homeowners' equity in this country has changed since even before the financial crisis. Significantly more equity in our housing market, right? The debt hasn't moved. The debt is back to where we were in '07. So this is not a debt-fueled real estate rally, and that's really good. Why do we think things need to cool? So you look at the purchase price of homes and what it's done compared to wages. So wages are moving up, but they're not moving up anywhere even close to what the prices of homes are moving up. So we're getting really large parts of our economy that are being priced out of going out and buying a house. And that at some point is going to take its toll. The other thing is that sentiment around buying a house is absolutely awful. And it's one of the reasons in the late part of 2021, we saw an explosion in rent prices. Rent's really moving higher now again in the last 6 months because so many people are saying, I can't buy a house. I've sort of been priced out of the market. So you're probably due for a little bit of consolidation in the prices of housing. We talk about this a lot, but it's important. Interest rates being so low are incredibly powerful for the average homeowner in this country, right? So going right before the financial crisis, the average homeowner, as a percentage of their disposable income, was spending about 7% on their mortgage. And you look at it where it's now, it's half. It's been cut in half since going into the financial crisis. So prices of homes have gone up, but actually how much you're spending on your mortgage has gone down. And that's the power of those really, really low interest rates. So Monica and Josh will talk about sort of the rate environment. As interest rates move back up, that's another thing that's going to play a little bit of a cooling effect in housing because that cost of having that mortgage is going to go back up again. Okay, let's talk about what worries us. And as I referenced, there are a few more things now that are maybe concerning us than last year. One is you look at, let's take stocks, for example, but you could apply this to real estate or you could apply this to different parts of the economy. There is not really a lot of things that are cheap. It's just a problem. There's good assets, but there's not a lot of good cheap assets. And here's the S&P 500. It's gotten a little cheaper because the earnings of these companies are going up so fast. So we're a little bit cheaper than we were in the middle of last year, but you're still just not a cheap market, right? I've talked about this on every call because at some point this is going to become a problem, and it's something that a lot of people don't want to talk about. And we're not going to dive into this deep again, but there's just a lot of companies. The 2021 numbers are about 20% of all publicly traded companies now are these zombie companies. In other words, the cost of their debt, not the amount of their debt, the cost, just the quarterly payments are more than the profits that these companies make in a quarter. So these are companies that if they don't borrow more, they go out of business. And you can see from the early 90s how much this has changed. This is a lot. Even at the peak of the dot-com, we didn't really get over 12% of companies that were in that category. So there's a lot of walking dead out there. Probably not enough that it brings down our markets and our economy on its own, But for you as investors, this is a time to be vigilant. And it's a theme you're going to hear from us for the rest of the call is most awful investment decisions are made during good times. It's just the way things are. People get too cocky, they get too arrogant, they make investments they would not normally make. They're feeling wealthier, and there's a lot of bad business plans that are running around. Well, there's a lot of bad bonds that are running around as well. And Monica and Josh will touch on this a little bit more, but this is a time for vigilance. And with this many bad companies lurking around out there, it's something you really want to be aware of. This is a little bit dated from the second or third quarter of last year, but it shows an important point. This is just examining the weakest 20% of publicly traded companies in the United States, right? Their balance sheets are worse than at the low of the financial crisis, right? So the weakest 20 are really weak. It's not as bad as the dot-com meltdown. Now, we all remember during the dot-com period, there was a lot of companies that were nothing. I mean, there were companies going public that had barely a business. It was one of the most wild, excessive parts in stock market history, right? So it's not that again, but it's drawing that direction. There's a lot of companies that really don't have any business being public and certainly don't have any business issuing bonds. And so a lot of people will think, well, I like these small tech companies, or I like, these higher yielding bonds, and you might be owning these types of companies. So again, I bring this to your attention not because it's going to lead to the market toppling over, but it could lead to some real pain in your portfolio. We're a little bit seeing this come to roost. Okay, so I want to give you an example of this. The NASDAQ right now is down about 5% from its high. And most everyone on here knows that unlike the S&P 500, the NASDAQ has a lot of smaller startup kinds of companies, tech companies and things like that. It also has the big boys, right? Apple and Amazon and Google and people like that. So you see that the NASDAQ itself has had this incredible run, and it's still right near its high. But look at this. 68% of the companies in the NASDAQ composite are down 20% or more from their high. Think about that. And 40% are down 50% or more from their high. Some of you may already be feeling this in your portfolio. You might own baskets of stocks that are very aggressive and maybe oriented towards the NASDAQ. They've been a very popular place for people to invest in this bull market. And last year especially, the Reddit gang, with all of these crazy meme stocks and things like that you've read about, really love trading these types of stocks. That group has experienced a lot of pain in the last 6 months. And some of you might have experienced that or tasted that. And so what's happened, this is both good and bad. It's bad because it's showing some weakness underneath the market. There's companies, these zombie companies and these garbage companies, they're out there and they're making up a little bit larger part of the market now. The good news is, in the past, in my career, sometimes this is the thing that really brings a market down. And so far, the market is not coming under real pressure because of the garbage companies that are out there. The market is actually acting really good in light of what you're seeing on your screen here. So it's something we want to keep an eye on. And here's sort of another thing that's in the market that's a little bit tricky, okay? If you go back to end of 2012 here, and you just look at the S&P 500, okay, and you look at the market cap of the S&P 500, you're looking at the blue line. This is that overall S&P 500 here. And market cap, by the way, is a fancy way of saying the total combined value of all the shares in the S&P 500, okay? But look at the top 6 stocks. This is the acronym here for those top 6, and you can see them down at the bottom. Facebook, Amazon, Apple, Netflix, Google, Microsoft, right? Look at the market cap of just those and what they have done since COVID. So much money has flowed into these 6 companies and these 6 stocks. And here's an example. Apple, all of the shares of Apple that trade is $3 trillion worth of shares now. It was only in the last 2 years that we saw the first time any company was $1 trillion. and it was Apple, and now it's 3 trillion. Okay. Read that statistic and it will blow your mind that Apple alone, its shares are worth more than all of those blue chip companies right there combined. It's a staggering piece of data. Is it an indictment against Apple? No. But it's something to be aware of because the market itself is becoming very, very top heavy. I can't remember exactly what the stat is. I didn't put it in here, but I think a full 25% of the S&P 500 now is in the top 6 companies, which is really very, very rare. So the market right now is at the mercy of those big 6 right there. It's a big deal. And that concerns us a little bit. When you look at those top 10, let's say, here's the top 10 companies in the S&P. Look at how expensive they are compared to their historical. This is actually a 20-year average. Okay, so if you go back 20 years, these top 10 companies, sort of the best of the best, they're pretty expensive, almost 70% more expensive than they have been in the past. And it shows you that the remaining stocks, though, are not nearly as expensive as compared to their historical average. So, it's something we sort of, need to keep an eye on because the market is now becoming so tied to these companies. Again, not something I love, not necessarily the thing to ring the alarm bell about, but something that typically sets a precursor to some consolidation in stocks. Other types of companies and stocks probably need to catch up at the very least. Another way of looking at this, right? Here's the Russell 3000, okay? The Russell 3000 are the 3,000 largest stocks in the market. The only thing I really want to show you here is if you look at the orange, here's what the Russell 3000 has done, okay? But look at what all of the non-profitable tech companies have done. So Goldman Sachs keeps this index of non-profitable technology companies. They're down, close to 30% from their high. So the market is underneath and nobody's really talking about it, but big fund managers are shedding those types of holdings. And I'm going to kind of skip over this. I want to move on.
Can we pause and do some questions?
Yeah. So there are a couple questions that came in on this.
Yeah, I think this one's a good one for Monica. So when you are saying, and obviously they're talking about you, when you are saying that you might own these companies' bonds, are you referencing the EIP? So I think that you weren't talking about the garbage. Do you mind?
It's a great question.
Mm-hmm. Yeah, well, that was in reference to.
I think the
the zombie companies. Yeah.
Right. So most of the companies that we buy in the EIP, we don't just do the universe of what's termed typically high yield or junk bonds.
Can't hear you.
Sorry.
Are we good?
In the EIP, we don't typically buy just everything that's in the universe of what's called, high yield or junk bond, which reach down into, a C-rated and even below. We hang up in the B to double B range. And additionally, we don't even do everything that's in there. We are doing a lot of credit work. And we have a certain restricted list of names that we do in that space. Companies that, we like their prospects. They're not the zombie companies, basically. So, but that being said, it is important to note how that metric moves because it does impact where spreads will go over time. And because there's really, I think from a longer term historical perspective, a lot fewer zombie companies than there were in the past. So credit spreads are pretty tight right now because the market in general views the prospects for most of those companies pretty well.
And a lot of those companies, I think, and I don't want to put words in your mouth, but a lot of the companies that would be considered zombie companies, they're not the types of bonds we would ever buy anyways. They're not liquid enough. There's not broad enough distribution. They're not the types of companies that would ever screen for us even to begin with, right?
Correct. Yeah, we're generally looking for companies that maybe, they could be investment grade, if not for maybe, something like they just don't issue a lot of bonds. They're maybe kind of small.
Too small. Yeah.
Right.
Yeah.
So that it again it doesn't get into our buy list, if you will. So it's not typically the kind of thing.
Right.
I think that ties in perfectly with this next or another question about determining factor. What factors do we use to determine whether a company is bad or garbage? And I think we've touched on some of those, right? Leverage, profitability, all of those things that we screen for, and also our managers are screening.
Yeah,
they want high quality companies.
And we should probably elaborate on that point. At the firm here, and many of you, we are managing a portion of your assets. What's super important is our bias as an investment committee is around what the industry calls high quality, which seems like a generic term, but actually in our business, that means companies that have a lot of free cash flow, they don't have big leveraged balance sheets, et cetera. They're not zombie companies. Most of the money managers that you guys use, in fact, pretty much exclusively across the board, you're not going to find those kinds of companies because it's not a part of the market we want to participate in. Now, it's great in a recession because you are not going to find our companies or Poland's or Kane's or Congress or any of these. You're not going to find these money managers owning these blowups. But sometimes it's a problem. And there are times in my career where you might go through 2, 4, 6 quarters where people actually are buying garbage. And what's happening is that's the best performing part of the market. So we saw that actually early last year in 2021. We went through about 120 days where the best part of the stock market was the junky part of the market. So for those of you that are doing this either at home or professionally, that you have to be disciplined enough to say, there are going to be times I'm going to underperform the S&P 500 by the nature of what I own. And it's actually a specific decision that we make. So last year, maybe you were up 20%, market was up 27%. I'm happy with it because I own the best of breed, highest quality companies. So that's a really, really excellent question and an important point to make. Yeah.
And that's how you outperform through the cycle.
That's right.
You own high quality. You're not going to, when the market's up 30%, you may be up 20%, but you catch up when the market's down 20% and you're only down 10%.
Right. Like during COVID and during the financial crisis, not more than 90% of our money managers outperform the benchmark during times of stress like that. And that's where we really want to play catch up and make a lot of extra returns.
And I think it's important to note also that our mindset for how we're choosing companies that we're going to buy the bonds of is totally different than where our stock managers are looking at, the valuations for stocks. We're looking for companies that are going to pay us back, basically. Yeah. So we're looking for solid financial fundamentals, fairly low, leverage, not too much debt. We just want to make sure they're going to be able to pay us back.
That's a super important point. Yeah. When you're buying bonds, you want to be sure they pay you back. When you buy stocks, you want growth. A different
Absolutely.
mindset.
So many of the companies that did so well, these super high growth, disruptive type companies, very few of them make any money at all. And people don't seem to care. They just keep buying the stock because they're really just looking at those very longer term forward estimates of growth and revenue.
That's right. They're looking for the next Amazon, right? Yeah, that's a great point.
Yeah, and somebody asked about Reddit stocks and whether our managers own those types of stocks. I can comfortably say no. I have not seen any managers own AMC or GME or any of these other kind of Reddit.
I suppose sometimes better companies are talked about in Reddit, but generally no.
It's important though, I think, to point out here, and we looked at this a while back, is that there are quite a few ETFs out there in the market that do own GameStop and AMC and some of these other stocks. And I think we did a pass through all of the ETFs in our models and so forth and found, I think there was maybe one ETF that had a smaller exposure, but there are lots of ETFs out there that do have fairly sizable. So it's important to, if you're sensitive to that, take a look at the ones that you own and make sure you're not inadvertently exposed to those.
100%. Should I finish up here and then we'll throw over to you? And then, okay, great. Want to touch on, I want to shift gears and really get into Monica and Josh's world now and talk about, the elephant in the room around inflation. And you can see here, these are sort of consensus estimates for 2022 as it relates to all the economists that are out there from all the banks, right? And all the think tanks. And you can see really since the spring of 21, people are finally catching on to, okay, there is some level of actual real inflation here. We could spend all day taking sidebars on this specific topic, but that's where the market's at. The market right now is pricing in 3 rate hikes in 2022. And it would be a fun debate for us to have if we actually think we'll get all 3 done. I'm actually myself going to be a little bit surprised if we get all 3 done. I think you probably have 1 or 2 for sure in the bag. And the market, the bond market is sort of pricing in those 3 hikes, April, August, and December. And I think Monica and Josh might elaborate on that a little bit. You can see the movement in the 10-year, right? Since COVID started. So we are now making new highs in the yield on the 10-year bond. In other words, the 10-year treasury itself is selling off and the interest rate itself on the bond is going up. And again, we sort of have broken out here into a COVID high. This is very rare. One of the things we all take for granted in bonds is I'm going to make something, even if it's nothing. But if you just look at bonds on a total return level, okay, right? if you own a bond, you're going to get a coupon, you're going to get some interest. So even if the bond trades flat, you still made a little bit of money. Well, we had a year last year. There's only been 4 years since 1975 that the overall bond market total return has been down. And you can see the worst one ever was 94. And this is why bonds typically are so safe, because you're going to make something in them. So I only point this out because it was a rough year for bonds last year. And there's a lot of crosswinds and things happening in the fixed income market to be aware of. And you're doing that inside of an ultra low interest rate environment. And other things on inflation that are really important, there's genuine wage inflation. At 6% wage growth on the Q4 reading, you are at the highest since 81, right? I mean, we people have been complaining in this country for years that we're leaving behind the lower income classes. Well, it's time to play some catch up. And there's some dynamics in the market here that are making it so that the employee now has a lot more leverage than they had before. And this is a real issue. We don't necessarily see this cooling off anytime soon on the wage side. Look at rents, and it's funny because you get the official Federal Reserve numbers on rents, and they don't look like this, right? So it's hard to say exactly what the data looks like, but you can anecdotally look around and see that there's a more inflation than is necessarily coming out in these core numbers here. One thing that I find really interesting, and this is something that's going to help inflation, is that 30 to 35% of the inflation data is just around vehicles themselves right now. And we're starting to see some easing there. We're starting to see incentives come out from the auto manufacturers. They're indicating that a lot of new vehicles are coming online, probably in the next 90 days. So that's really good. So that's part of the inflation that we can actually reel back in and find more taming in. I think this is an important chart. It shows what that 2% inflation trend line actually looks like for the CPI. And you can see that during COVID, we dipped under it, and now we're correcting back up. And our team mostly feels that this will normalize and get back on some kind of trend line, maybe slightly higher than where we were before. So we're sort of normalizing some of these really bizarre shocks that were created because of COVID. You can also see in the yellow, this is where most of the inflation is. So this is no secret to anybody that lives in this part of the country, is that a lot of people have left the Northeast and the Pacific Coast to find our friendly climates out here in the middle of the country, and it's created a lot of inflation. One other thing that's really important, Monica's talked about this in the past, you cannot underestimate how important this is. You see the trend line of people retiring in this country. Well, look at the explosion in retirees because of COVID. There were a few years of retirements pulled forward because we went into COVID and people just said, I'm done. I'm just going to go ahead and retire, take early retirement, and I'm out of here. And you combine that with the annual increase of the number of 65-year-olds in our economy. There's a lot more. This is an aging demographic, right? So it's not totally surprising to see this, and this is probably not going to stop. So this is something that's kind of creating some disruption in the labor market. And I'm going to kind of blast through a couple of these in the interest of time. You can see auto inventories. We talked about that. Hopefully, we're going to get this auto inventory thing to change here in the very near future. So one thing that's important, we get a lot of questions on this about inflation, is hedges. And we have looked at this data. Josh and the team spent a lot of time on this. There is no way around it. Real estate and stocks have historically, through almost any meaningful window of time, have been the best inflation hedges. There are times that oil and gold, and now Bitcoin, I guess, if you want to throw that in there, there's these tiny windows of time that you can find over 6 months or 9 months where those have been great inflation hedges. But honestly, they're not enduring. Stocks and real estate are where it is at when you talk about inflation hedges, and we won't get into the why, but there's limited real estate, there's limited equities, and these companies are passing on the inflation to their customers, and they're making more money. I showed you on the very first slide, we're in an inflationary environment the last year, and look what earnings have done. They've exploded because you and I are willing to pay more for our iPhone or for whatever that it is. Okay, one other thing that I don't like seeing, okay, the number of people betting against the stock market continues to shrink. There's a lot of optimism. I'm hearing more cockiness about the stock market literally in just the last 90 days. I don't like that. There's two great times to buy assets: when they're cheap and when they're hated. And ideally, you want both. You want cheap and hated. And I'm not seeing a lot of cheap, and I'm not seeing a lot of hate. And so probably we all need to temper our expectations about what the stock market's going to do over the next 2 or 3 years. I hope it keeps going, but there's starting to be some complacency. I'm starting to get those calls that say, hey, my financial advisor only returned me 18% and my buddy got 24%, and I'm pissed about that, right? I'm starting to hear more of that. Hey, I saw Bitcoin did this last year. How come my stock portfolio only did 20 or 25, whatever the number is? That's ridiculous, okay? So we're starting to see the front edge of greed leak back into people's dialogue. And that is almost historically a really fine time to have the market punish you for being reckless and cocky, right? So I'm going to circle back in a minute after Monica and Josh talk and kind of close this up, and we'll kind of hit that theme a little harder.
Yeah, and I don't want to belabor the conversation around inflation because Kurt already covered some of it, but I do want to kind of unpackage a little bit of the data so that way we kind of understand what we're seeing. But the reality is inflation is going to be stickier this economic cycle. We've been talking about this the last few quarters. I think inflation has been higher than what I personally was expecting, but I think things are going to turn over, and the inflationary numbers are going to improve over the next kind of 12 to 18 months. We are seeing a broadening of inflationary pressures. And so Kurt was talking about this. It's not just energy and new and used cars anymore. You're starting to see some other drivers of inflation. And so that's something that obviously we're monitoring. But at the same time, you still have this base effect. And I'll go to the next slide to talk about that. Energy is still a major driver of the inflationary numbers. And so we'll take a look at that. And I think just broadly speaking, there still are these secular disinflationary forces that remain. Technology, aging demographics, globalization, all of these things I think will help result in lower long-term inflation. So we're not going to see 6%, 5% inflation over the long term. Looking at crude oil, and Monica actually just passed me a note that WTI crude hit 81.5 today. It's just crazy. But this is why energy is such a big driver of inflation. You look at towards the end of 2021 and you see, crude was at $40. And then you go forward about a year and you see that crude was up at, close to $80, right? In the 70s. And so, over 80 towards the end of last year. And so that's going to be a major driver of inflation. That's 100% increase. And that year over year look is going to make inflation look higher. But you go out a year and I think that we're going to see crude trade, in that $60 to $80 range pretty comfortably. And so that driver of underlying inflation numbers is going to change.
And a couple of things I think, they're really important to remember here. On oil, this recent pop-up in the price, a lot of it is just related to the recent pop-up in interest rates. And that happens a lot of times when interest rates do, spike up a bit, oil will increase. And might lead you to think, well, maybe it is a great inflation hedge after all. But as we pointed out before, it does, crude oil does tend to respond pretty quickly to just spikes up in rates, but over a longer period of time, it's just not as responsive to overall inflation, right. As say equities are. And also OPEC has come out and announced they are going to increase supply to try to combat some of this recent spike up in rates and you might think, why would they do that? Well, they don't really want $100 a barrel oil. They've said so. They don't want that because it attracts too many competitors. It causes the U.S. to release strategic oil reserves, all sorts of things that people do in response to, huge spikes in oil. So they don't want that. They like it to be between about 75 and 85. That's their sweet spot. So it's probably going to stay there. But yeah.
And there's still a lot of supply that could be brought back online right here in the U.S., right? I mean, all that stuff that got shut down in this last cycle. Yeah. It's like it's all still sitting out there, and with the turn of a key, it can be thrown back on. So you've probably got a lid on this thing, right?
It's 85.
Yeah. Yes. Everybody and their dog's back in business.
That's why OPEC doesn't want that.
Yeah.
So let's dive into the numbers real quick, and then we can jump off of inflation. So looking at headline inflation. So this is what I'm talking about with energy. Energy makes up, almost 37% of the inflation number, even though it's only 7.5% of the weighting. So you fast forward a year, if we have $80 oil a year from now, that's going to be zero. And that's going to be a big disinflationary pressure on the inflationary numbers.
And that's important to remember because prices have jumped up on everything. Take energy here, for example. But if it stays the same for 1 year, inflation is zero.
Exactly.
Right. So it's not, we forget that sometimes, that you're measuring a 1-year change, and we went through this big jump, and the odds of having the whole basket
Another
do this
big
again
jump.
next year. Right.
This is what I call a step up. There's going to be a step up in the cost of living for sure.
Yeah.
But I don't think that we're going to be this cyclical inflationary kind of situation. Used cars and trucks, right? 15.5% of the overall inflation number, but it's only 3.4% of the weighting. So that just shows you how much those factors are weighing on the inflation numbers. This is core inflation, so stripping out energy, stripping out food. This is a very similar story. You're looking at new vehicles, 5% weighting, yet makes up 11% of inflation numbers. Used cars and trucks, 4.3%. It makes up 27% of the inflation numbers. Once things normalize, once the supply chain normalizes, this is going to go away. And in fact, you're going to see used cars and trucks in, I don't know whether it's going to be 12 months, 18 months, 24 months. It's going to be deflationary.
Yeah.
It's crazy. I mean, I just bought a minivan, and I could buy a minivan new for $43,000, or I could buy that same one that has 10, 15, 30,000 miles from the year previous for $5,000 more. It's crazy
Upside
what's
down.
going on right now. So, but that will change. That's going to solve itself. Okay, we'll move this over to Monica.
Okay, yeah, let's talk a little bit about, where we are in rates and what what we're seeing from the Fed. And that's a, rapidly unfolding picture at the moment, as we just had Chair Powell talking to the Senate this morning, his confirmation hearings and so forth. So some of his comments have actually driven some of the movements that we've seen this morning. But the Treasury curve, as you can see from a quarter ago and a year ago, obviously we're higher from a quarter ago, we're higher from a year ago. A lot of the move, over the last year has been really just in the last 30 days or so. We've had about 35 basis points upward movement in between 2s and 10s, and about 80 basis points over the last year. So, we have been up, and most of you have noticed that. But I think what's important here to point out is that movement. It's not entirely unusual, and when we are in a pretty good economic boom and rates are going up, that's typically how it happens. It's not a one-time spike. It's it's kind of little fits and starts and a fairly gradual rise. But as I said, Chair Powell's been testifying this morning. Over the last 30 days, a lot of what's really driven rates up has been some of the more hawkish comments that came out previous to today in Fed meeting minutes, and particularly some of the more hawkish governors who are now coming on to the FOMC. There's been a little bit of turnover there. So a lot of these more hawkish comments that are calling for maybe 3 or 4 Fed tightenings this year, and for an end to QE a lot more rapidly than maybe we had thought. That's kind of been driving, this increase, as I said, about 35 basis points or so up in the last 30 days. But, again, rapidly unfolding in Fed Chair Powell's comments this morning, he got a little more dovish. He didn't necessarily come out and say, yeah, we're going to start hiking aggressively. So that's kind of dampened that a little bit and drove stocks back up a little bit as well. So it's kind of a day-to-day thing, but we think overall we're still on track for the Fed to finish the tapering sometime in March. The market, as Kurt mentioned, is pricing in about 3 tightenings this year. And we do have some more, hawkish incoming Fed members, but we think, it's important to remember they do have those 3 goals that are going to have to be met before they really start tightening, and that is, that sustained inflation over 2%, overheating GDP, and a return to full employment. And we're not out of the woods on all of those, and how much they're going to let inflation run is going to be the bigger question. They've already said, yes, we're going to let it run a bit over our 2% goal for a while. They've dropped that transitory language, but they're still going to want to see some sustained movement there. And and what do they think full employment is? We don't know that either, and that's very difficult to peg right now because of all of the issues. Tons of people leaving the workforce. We had 4 million people quit their jobs last month. Absolutely incredible. And so it's very difficult. We haven't seen the participation rate really tick up as we thought it should have. It's very difficult for people to know where have all these people gone who quit their jobs and, tremendous labor shortages. So
it's a
that's
lot
a
of
hard
factors, right?
number.
It's not just one thing that's creating a dislocation. It's
Mhm.
people either aren't
Yeah.
trained. I'm going to take a year off because I built up enough cash.
Yeah.
Like, it's a variety of
Absolutely.
reasons.
I saw some numbers the other day. It said that they think that about 40% of the people who left the workforce were early retirements. And that makes sense from just anecdotal evidence that I've heard, and particularly in healthcare. Tremendous number of people have just early retired from healthcare. And we already had the problem of an aging workforce in that area. And that's, I think, going to continue to just exacerbate. So that's why it's really difficult for the Fed to get a handle on what full employment is. What numbers are we going to have to see? So I think there is still, there's that probability of multiple rate hikes this year. But I actually think that, if they do 2 of them, they're probably going to find that it might be a little too much because I think there's going to be a good bit of vulnerability to the economy this year, particularly, toward the April to June timeframe, as we maybe see some of these labor shortages and supply chain issues and really the increased demand in things like housing and cars and all of that we saw because of the pandemic start to work its way through. I mean, demand for cars can't go to the moon. People, there's probably a lot of people who, because of the pandemic, aren't doing public transport anymore, so they went out and bought a car, and that's responsible for a lot of it. But that can't continue to increase to the moon. It's got to level off at some point. Same thing with housing. People move because of the pandemic, and at some point, though, everybody's where they want to be, and we get back to a normal.
And we're kind of already seeing it, like in consumer spending. Christmas was actually ended up being a little lower. What was interesting was there was this big bounce back through the year coming out of COVID of spending, and then actually a little bit of a cooling going into the end of the year. You're starting to see this normalization a little bit, and it looks like that's probably going to continue. And I'm with Josh. I actually think you could see a few of the inputs might be deflationary 1 year from now because they got a little too hot, whether it's autos or whatever it might be.
I think that's going to play out, and it may take again until August to June kind of time frame before we actually see it in the numbers, because that's a bit of a lag. But I think that's probably a case for maybe a couple of tightenings, and then they might have to be on hold for a while. And again, that's still a fairly normal way for these things to play out. And one other thing I want to point out, I'm starting to hear a lot more discussion of this term, the soft landing, and whether the Fed can engineer this soft landing. And I think that's again another difficult one to call, because this isn't like a normal period where we have an overheating economy and a tremendous amount of employment, and then inflation starts to tick up. These things have sort of happened a little bit upside down. We do have, the economy is increasing. Yes, we've started to see inflation tick up, but there's still so many issues and crises caused by the pandemic that, it's just not a normal. I don't know if soft landing is even a term we would use. I think it's more of a soft takeoff would be the term you would want to use. But but I think they're going to be pretty cautious, a lot more cautious about tightening than people think they're going to be. So with that,
we got a really good question just about the Fed, and they're not planning on direct sales of bonds, and they're planning on letting them mature. But are they worried about are we worried about the unwinding of the Fed's balance sheet? And Monica, you can answer after me, but I would say I'm not that worried. I think the Fed has been very good about being very communicative of what they're doing and communicating well in advance. And you see that with Powell today talking, and what did the market do? The market really rallied. And so I think that the Fed's going to do a pretty good job. Looking back, the last time, we've really only had one unwinding, and they didn't even unwind it that much, but the markets performed pretty well. There was a little bit of volatility, but I think the markets performed pretty well when the Fed actually started unwinding a little bit of the balance sheet. Like I said, they didn't get very far though before COVID hit.
Right.
So
I'm actually not all that concerned about this at all, and I've actually been kind of saying this for years and years and years since the last QE tapering, that one of the longer term secular themes in the bond market really over the last 20 years has been, more people retiring, aging workforce, more pensions de-risking. There's just tremendous amount of money in the bond market, demand for bonds, and particularly on the long end, that the bond market can handle almost anything. In terms of you could just dump a ton of supply in the bond market and it will get sucked up so incredibly
fast. And think about how patient the Fed's balance sheet is. I mean, they don't need to move. Like, there's no rush and there's no hurry. And Josh is right. They have been telegraphing this so good. They have done such a good job In the old days, they felt like they needed to be stealth. Early in my career, remember, they felt like they couldn't say anything.
Mhm.
Now they've learned that by jawboning this stuff in advance, they get right where they need it to be anyway.
Yeah, absolutely. And everything that's happened, with the labor issues that are going on now, more retirements and such, that's just adding fuel to that fire.
Right.
And lower birth rates.
Right.
That's another one. That's just, that's
The birth
adding,
rate data is unbelievable.
that's adding fuel to that fire.
I'm only half joking when I say I thought COVID was going to help birth rates in this country. It did not. It hurt them. It plummeted.
And not just
Maybe
here,
people
but
didn't like being together at home. I don't know.
all over the world. It's the same.
It's crazy.
Same thing.
I know.
Yeah. So
Okay, let's jump in. We don't have that much time. So credit spreads, we saw a backup in spreads, right around the Omicron kind of crisis, looking at towards the end of November, and it has not come back. And so this is actually, I think, pretty healthy. And I think there's a couple things going on. Obviously, worries about Omicron, but also I think people looking at rates and where rates are going, investment grade bonds, historically speaking, all things being equal, are going to underperform in a rising rate environment. And versus high yield, which you saw a correction in high yield, but you've seen it come back and spreads kind of tighten in, although overall spreads, I would say on average, are wider than where they were kind of on average last year. And so we did see a little bit of a correction in high yield, but the correction in investment grade bonds has definitely been stickier, which I think is just the fact, tied to rates. And also I think it provides an opportunity maybe for this year for spreads to tighten a little bit more on investment grade. Broadly speaking, muni bonds still look relatively attractive for clients in the highest tax bracket relative to investment grade bonds. That trade has not gone away, although I think it's kind of closed a little bit on some of the repricing on the investment grade bonds. Investment grade corporates, like I said, spreads have repriced. I think issuances this year are expected to decline about 30%. And so that's going to be a nice kind of trend, I think, from a supply demand dynamic, which should help spreads a little bit. If there's less supply, but demand still stays the same, that should help spreads and help performance. But overall, I think the incoming tide of rising rates is going to hurt investment grade. It's going to hurt treasury bonds a little bit going into 2022. High yield, spreads reset a little bit. They trade wide relative to kind of the average for 2021. I think high yield is poised to potentially outperform IG in 2022. I think just historically speaking, when you're in a rising rate environment, high yield, because you have that additional yield, it gives you more of a buffer and it's less sensitive to interest rate moves. And so that creates an opportunity, I think, for high yield to have a pretty good year, I think, in 2022, as long as we don't have any major economic shocks. Overall, I think bankruptcies in investment grade and high yield are going to remain relatively low compared to historical levels, just given how much went bankrupt in 2020. I think we're going to have a few years of low bankruptcy rates. Okay, back to Kurt.
Okay, thanks, guys. Well, let's close with this. So what now? What do we do now? So a reminder, you look back here to 1980, most years in the stock market are up. That's really, lost on people from time to time, but the average year has a 14% sell-off, right? So the red dots down here at the bottom are how much the market dropped during the year. And of course, here's the COVID drop. And since then, we've not had a single drop more than 5%. And we're kind of around another one now, but we just haven't seen a lot of market volatility, and it's coming. Another theme that's kind of interesting is how dominant US equities have been. So this is a 50-year chart. And when the year is purple, like here, international markets are outperforming our markets, right? Well, we're 14 years into the US market outperforming international markets. So to put it another way, international stock markets have never been this cheap compared to the US market ever since the data has been recorded. We're almost 3 standard deviations away how cheap international stocks are to US stocks. It's neither a recommendation to buy or sell. Do I have to say that for compliance reasons? But it's something to be aware of. Okay, game plan. We're closing with this slide. Okay, number one, you've heard me say it before. My mentor on the floor of the New York Stock Exchange used to always say, sell when you can, not when you have to. This is when times are good, as they have been for a very long time. This is the time to get rid of crap. And I'm not just talking about in your stock portfolio at Schwab. I'm talking about anywhere in your life. So I don't want to own things I'm not committed to. honestly, anywhere in my life. It can be private investments or certain types of real estate or whatever. It's really hard to find an economy that I can, I showed you the data at the beginning of the call that's better than this, right? So you have to be disciplined enough to do some rebalancing. Maybe the large cap growth part of your portfolio has gone up, 100% in the last few years. Well, take some off and buy something else that's maybe cheaper, that hasn't gotten that same kind of love. Maybe you hold a few more bonds than you normally would because you're going to have a little dry powder for a rainy day, pay down a little debt, whatever it might be. You need to do it when times are good. We want to avoid complacency, and it's a big deal. I'm going to say it again. That we're seeing the front end of people being cocky with their money, and it hasn't been that way for several years now. People were nervous with Obama. People were nervous with Trump. People have been nervous with COVID. A lot of cash out there, but you're starting to see these little weird signs again of people getting cocky about what they do with their money. You want to know what you own, right? So you don't want to be blindly buying assets. You want to understand what you own. We talked about how there's a fair amount of companies that trade in public markets that are complete garbage. So you want to understand what you own and then why you own it. Know why you own something, right? I haven't seen it in a long time, but I'm hearing people, like I said, sort of saber rattling because, they heard their buddy was up 40% in his portfolio, or I own this one meme stock that was up 50%, or my Bitcoin. So, a lot of the portfolios, a good portfolio actually arguably should do a little worse than the market during some periods in exchange for doing a lot better during other periods, right? So not all assets are created the same. And it's one of the problems with just blindly looking around and saying, hey, the S&P 500 did this. Well, the S&P 500 might not be the goal, because there was a time in my career where the S&P 500 went down 50% in 6 months. Well, I don't want a portfolio to go down 50% in 6 months. So again, knowing what you own and then also why you own it, right? We talk about how we have this bias towards high quality assets. I know what I own and I sleep well at night owning it. I don't have companies. We don't have companies in this firm that are relying on financing to keep them alive quarter to quarter. And sometimes those stocks are really high flying and they do great, but I'm not going to own them, and I'm totally fine with that. We talked about expecting volatility already. It's coming again. Maybe barbelling your approach. I know it's very hard to own super safe assets at times like this, but you want to own some. You need part of your portfolio to be uncorrelated from the rest of your portfolio. You need some liquid, safe assets somewhere in your life. And then when the market gets throttled like it did during COVID or whenever, you actually do have some money to spend, right? That's the time you can come back and say, hey, the two things I'm looking for, once in a decade buying opportunities are things are cheap and they're hated. And are you going to have some dry powder around when that happens again, right? And then maybe consider some alternatives. Not everything that's great trades in the public market. There are private securities that trade that are really, really high quality with really compelling features to them. And so you want to talk to your financial advisors about, hey, are there maybe some things we're not looking at that just aren't in the public stock and bond market arena? So anyways, we're done. Josh, Monica, awesome. Thanks for taking the time. And anything you guys want to add before we jump?
Yeah, nothing.
Hope everybody has a great 2022. And as always, we're incredibly appreciative for the trust you put in us and our team here in managing your assets. And don't hesitate to reach out with questions, and we'll get this replay and these call slides distributed out. Have a fantastic week.